I'd just say in general, if you're on and not a member for OTC for the Orlando tech community, this is just kind of a sampling of some of the initiatives that we're doing and we're pursuing, and there's obviously a lot of reasons to join and get connected. So if you're interested, feel free to reach out to any of us. So today we have Ben Liakos from Cogent and Derek Barnett. Ben is the Central Florida market president for Cogent Bank, and Derek Barnett is executive vice president and head of innovation banking based in South Florida. So obviously, with the financial markets and banking being in a unique spot after the developments with Silicon Valley Bank and First Republic and others in this kind of innovation economy of banking, we thought it would be timely to bring in a couple people that are more or less experts on the topic, and bring in leaders from an organization like Cogent, who's super active throughout Florida. And then furthermore, I just say in general, a lot of time and energy and attention gets spent talking about venture capital and kind of the equity side of this equation of the capital stack, but there's not education and content and discussion on the banking portion of it as well. So we thought it'd be great to have Derek and have Ben join us to kind of shed some light on the aftermath of these developments in the banking sector, and also just provide some kind of overview and content that's relevant for a lot of us in the innovation economy from the banking side of the house. So I know no one joined this to listen to me talk, so I'll shut up now and let Ben and Derek take it from here.
Thank you, Ken. Excited to be on the call. Really, I think two really key components that Derek and I offer, two different sides of what this innovation banking space is. Derek got a great background in the VC space as well as banking, where my background is primarily in banking, but I've been in the founder's chair helping start Cogent Bank from the ground up. Have been in front of capital partners and kind of started to get things together. So my background, again, primarily in banking, but helped start Cogent Bank about 5.5 years ago. And taken it from about $65 million in assets, which is a small bank we acquired out of Orange City, to just about $1.7 billion in assets today, really with a great team of people around us. So I will kick it over to Derek. Derek's going to go through the first part of this presentation, but also give a little background on himself on just the environment in the innovation background or innovation bank background and really the events that have happened in 2023. Derek?
Perfect. Thanks, Ben. And thanks, Ken, and thanks, David. All great intros. So my background, as Ben alluded to, is more venture capital based. I actually was at Silicon Valley Bank during the blow up, so I can talk a bit to that. And then prior to that, did about a decade of venture capital investing at early stage. So your pre-seed, seed, Series A, road checks of anywhere from $250K to $5 million. Prior to that, private equity, lower mid-market buyout. Prior to that, hedge funds. So very much on the investment side of things, and have a perspective on a lot of what the venture capital markets have been doing, as well as been around for a while. So I've seen some of these cycles exist. So with that, I'm going to share my screen. Let me know if you can see that.
Yep.
Perfect. So the innovation economy. So we're going to talk about it just quickly. I know there's been a lot of talk, a lot of new things in the wake of Silicon Valley Bank, in the wake of First Republic. So just in terms of the definition, we really define the innovation economy as three different participants. The innovators, which are usually early stage technology companies. They're typically venture backed, but can be bootstrapped. Bootstrap just means they're using their own capital. They're typically rapidly scaling. They're disruptive, highly scalable for the most part. They embrace new business models. Focus is typically on data analytics on the back end. We'll see a lot of that. AI is something we hear a lot about as well now with a lot of these companies. So that's kind of the core. Subsequent to that, you see the capital allocators. So those are going to be the venture capitalists, the ultra high net worth individuals, depending on the stage and maturity. It's a different group of individuals that typically fund these innovators and their companies. And then on the outside of that, you have the service providers. So we as a bank would be one of those service providers. You have your lawyers, your accountants, and a variety of others that all help to service this innovation economy and make it flow. So the innovation life cycle is a little different than possibly some of your smaller SME companies, although somewhat similar. So really, when you start your company, you're typically bootstrapping it using your own cash, using your own capital. You'll start with an idea, you'll start to build up that concept, move towards an MVP, and then from there, typically look around MVP to bring on some startup capital. You'll hear a term called FFF or angel. FFF means family, friends, and fools. I didn't come up with the term. That's just the term itself. It's a little, we'll say facetious, but also you get your angels, and it's more or less your family and friends. Angels are usually high net worth individuals, the people who are very wealthy that will allocate some capital early to these companies that they think have a great disruptive idea that will become your Ubers, your Facebooks, your Metas, whatever you think of in terms of highly successful technology companies. They'll see that somewhere in the company and in the founder, the potential to grow this company rapidly. Once you start to get going and once you start to get traction, some revenue, that's typically when you start to bring in your institutional investors. You'll hear the term pre-seed, seed. It used to be at your kind of early stage, and you'll call it a Series A when you bring in your institutional investors. But we'll see a lot come in at that seed stage now. So it's really, between Series A and seed, that's when you start to see a different group of investors come to help. And that's where your capital starts to be drawn from. Once you get into early stage and late stage, it's more institutional investors. So you'll see a lot more of those venture capitalists. You'll sometimes see family offices there as well. Family office is just an office that manages an ultra high net worth individual or multiple ultra high net worth individuals' capital. Typically 250 million is the cutoff where you have enough capital to start your own family office. So they're typically higher than that, but they'll also invest in this asset class and will sometimes be quite helpful early on due to the fact that they sometimes are more willing to see the vision than need the metrics that a lot of institutional investors will look for. But that's where the capital starts to come into play. And the reason we're going through this is because we're going to talk about alternative sources of capital than the ones that we're typically talking about here. And you can start to see where the capital comes in from early stage to late stage. You also see that in the initial period of the actual company, there's a lot of negative cash flow. You're typically not generating positive cash flow. You're pumping most of your excess capital into the company itself so that you continue to grow that company, bring on more staff, build out infrastructure. And then it's not until more the middle of early stage or the late stage that you start to see that cash flow positive in the metrics that allow you to be profitable. Moving in the types of instruments that you'll typically see, equity is something that's probably been discussed multiple times, typically coming in the form of standard preferred equity and sometimes structured preferred equity. We're not going to get into that. A lot of times early on, you'll see a convertible agreement of some sort, typically a SAFE. Y Combinator came up with those. They're just an easy way to get capital quickly. And then on the debt side, which we're going to discuss a bit more later, you'll see convertible notes. Some companies will use those early on to invest in founders. They're a little tricky. There's some pros and cons to those. And then venture debt. And as I'll go in a bit later, you'll see when venture debt typically comes into play. And it's not necessarily at the earliest of stage. It comes a little later, but it's a good source of capital when you're not looking to dilute further. Although sometimes there will be some warrants, and warrants are just convertible instruments that typically turn into equity at a later date. Equity is really flexible in terms of there's not an ongoing monthly payment or quarterly payment or whatever that payment structure might be. It's a high cost of capital because it's ownership in the company. And then as you move to debt, it's a bit more restrictive. There'll be covenants, contracts, everything where you'll typically have to pay something out. And it's not typically as flexible, and that's the downside to the debt. So who are the capital providers that provide you capital as you're growing your company? I think we all know venture capitalists are out there. You have your standard venture capitalists that are an investment firm that all they do is invest and they're looking for financial returns. And then you have your CVCs, your corporate venture capital groups that will also invest based on strategic alignment. A lot of large companies will have that. Family offices, I mentioned before, they're managing money on behalf of ultra high net worth individuals. Usually 250 is the minimum there. Angel networks. These are networks, and you'll see them quite often early on, that bring a whole bunch of high net worth individuals together, and they'll syndicate the deal. So there's Miami Angels, there's Tamiami Angels, there's a whole bunch throughout our ecosystem, Gold Coast Angels, and you can go to them and they'll look to bring on capital through their network of ultra high net worth and high net worth individuals. You have the individuals themselves, these high net worth individuals. So these are wealthy individuals looking to allocate into private markets. And then you have the banks like Cogent and like SVB and like First Republic, where they come along and they don't necessarily invest in your company, but they will deploy capital in the form of debt to help you grow your company. So let's talk about some of these innovation banks that did exist, and let's talk about some of that background, because that was really interesting. In March of this year, we really saw, due to rising interest rates, slowing down in funding, sector concentration, and a lot of companies drawing down on their checking account, this crash of SVB, First Republic, Signature, Silvergate was in there, but there's some other complexities there as well. But really, with a lot of these, what you saw was the concentration and the slowdown of funding really create an issue that led to a almost Twitter-filled, or one may argue Twitter-filled, bank run. It was challenging. I was there. I thought there's $42 billion on March 9th that went out of Silicon Valley Bank. So a lot of capital left, and a lot of capital left to some of the bigger banks. You'll see JP Morgan took half, Mercury took 20%, Brex took 9% of this capital. So it was a really tough time. Silicon Valley Bank had been a 40-year bank. They're the 16th biggest bank in the US economy. And just due to, whether you want to say mismanagement, a series of unfortunate events, it's your opinion on how these things could have, really affected, as well as the digital ecosystem being able to transmit information quickly. We did see a bank run in 2023, and we did see the restructuring of a lot of these banks. Silicon Valley Bank is now owned by First Citizens and operates independent. First Republic is now owned by JP Morgan, and Signature Bank is owned by, I forget the name, but they also have an acquirer there as well. And these banks continue to operate, but subsequently impaired to where they used to be in terms of assets under management and staff as well. So it's interesting to see that concentration really did affect them, but you're also going to start to see a lot of banks like Cogent, like a lot of these other banks, roll out innovation banking lines in a more balanced and a more diversified manner, which will still allow the innovation economy to thrive. It'll just be less concentrated probably than just at SVB, First Republic, and some of these other banks. That being said, what has gone on in terms of just capital, and we're going to get into debt capital and some of that later, but this will give you an idea of just where capital has been. You're going to hear a lot of people right now talk about, allocations are way down, things have slowed down, and yes, they have, from 2021 to 2022. And this graph here represents only the first half of 2023. But if you look at 2018, 2019, and 2020, the numbers are actually pretty even to where we are in 2023. So if you take out these outlier years, one might even argue that allocations aren't down, but they've gone back to normal. So that being said, as innovators, as capital providers, as service providers, we can look at 2021 and 2022 and say, hey, those were really great years, multiple expansion, capital deployment. But this year isn't necessarily an abnormal year. It's just we potentially have gone back to the normal that we were used to prior to these outlier years. And in total, $5 billion has been deployed in the first half of this year. So H1 2023, H1 just means first half. And you can see it's primarily been deployed actually in angel and seed rounds. Down there below in the grid, you'll see where the concentration of that investment has gone, and about 6,500 deals have actually been funded in 2023. So there still has been capital that's allocated. The first quarter of 2023 was a lot slower, but 2023, the second quarter, it's picking back up. So we're starting to see that growth in line with what we saw in 2018 to 2020. Looking regionally now, where are we in terms of Florida? Florida, in terms of the United States, ranks 8th in capital allocated, and we've deployed about $1.4 billion in equity capital. So the money's still coming. The big change for us in Florida is in 2022, we saw almost $9.4 billion allocated throughout the state. So there we're starting to see a real slowdown. But if you look again in that 2018 to 2020, we're on par, if not, potentially going to exceed 2020 if things continue to grow in the manner that they have. You'll start to see concentration again still in California, New York, and Massachusetts. Those have been kind of, San Francisco, the Valley, New York, and Boston are typically your 3 biggest ecosystems. And there's still that level of concentration there. If you look into kind of where it's getting deployed in kind of the metro areas, you can see, San Jose, San Francisco, Oakland is going to be top by far still, even though a lot of what we've heard there is, the city hasn't been doing as well, and then followed closely kind of by New York. And then Miami is kind of down there at the bottom, taking a majority of what's been deployed in Florida. So there still is money coming. It is still in those concentrated areas. Unfortunately, we didn't retain the 9.3 billion as it stands yet of 2022, but hopefully things will continue to improve. That being said, the good indicators and the really nice thing that also happened in 2021 and 2022 was a lot of capital was allocated to funds. You'll see record-breaking years in both 2021 and 2022. 2023 obviously not going as well, but again, not outside what we saw, in 2018 and 2019. The good news is anytime you raise capital the first 4 years as a fund, you typically have to deploy at least a third, if not half of it, depending on the strategy itself. There's usually an initial investment period. So this capital that was built up in 2021 and 2022 actually will need to be deployed. And that looks good for a lot of early stage innovators. And if we start to look at the dry powder that's available, and dry powder just means unallocated capital, because when you raise a fund, it's not actually giving them a fund the money right away like you would when you're buying a stock or a bond or anything on a public market. You're actually just making an initial commitment, and that commitment is pulled down over, the life of the fund, typically the first 5 years, 6 years. What we'll see is there's about $280 billion of dry powder that's available. And because that initial investment period really is in the first 4 years of any fund, that 2021 and 2022 record-breaking year in terms of fundraising is going to need to be deployed over the next 3 or 4 years so that these funds can collect management fees, carry on investments, anything to that extent. So the slower they are now to deploy, the more they'll have to hurry to deploy it later in that initial investment period. So there is capital coming. VCs right now are just being a bit more picky where they allocate, and multiples have come back to, we'll say they can be compressed, but I think they're somewhat normal now. So we're starting to see a lot more normality and levels in line with 2018, 2019, and 2020. That being said, let's look at venture debt. Venture debt is something that we see a lot of, and venture debt isn't as prevalent. And we saw 85 billion of equity capital being deployed in the first half of this year. There's about 6.3 billion of venture debt that was deployed throughout the United States. And you can also see the concentration of where debt is allocated. So if you are considering venture debt, and this is something that of interest to you, you can really start to see that early stage, you're probably not going to be able to get venture debt. Really, there's, countrywide, 240 million that's been deployed in angel and seed. So it's very abnormal to see usually at that level the deployment of capital, especially at angel. see there's been some programs where they've started to launch that. But again, when I even was at Silicon Valley Bank, they were just, even though they had been out for 40 years and started in 1983, they just started to do seed-based venture debt in 2022. So that's abnormal. What you really see is in late stage and venture growth stages, that's when you start to utilize venture debt. Venture debt's quite advantageous in the fact that it's typically not as dilutive. Sometimes there'll be equity warrants, sometimes there won't be attached to it, but it helps you prolong, and we'll get into this a bit more, kind of your runway past the typical 18 months that you see between capital raises on the equity side. So that being said, some of the venture debt or debt structures that that innovators use while they're growing their company, especially on the early side, can be factoring, PO financing. Those are quite common. That's where you're taking invoices either that you've sent out when it's factoring or POs that you've received when it's PO financing. And when you're working with companies, say Walmart, say CVS, bigger companies with great credit, people are quite comfortable lending the money, and you're 6 to 12 months in or 24 months into a new company, you can take those invoices or POs to certain financial institutions, and they will say, hey, instead of having to wait 30, 60, 90 days, whatever that period is, we're willing to give you a piece of that capital that you've been promised by these very creditworthy companies early. So you see that quite often, depending on the kind of company or the product, the service, depending who your counterparties are. That's one way that you can look at getting capital quicker. It is expensive though. There's a lot of people out there willing to do it. You typically will pay anywhere from 1.5% to 4% a month. So you need to be careful with utilizing some of these things. If you're not growing rapidly and it's not going to be worthwhile, it is quite expensive. Revenue-based financing is another way you can go, where typically if you have strong recurring revenue, a company will provide you a percentage of your revenue in either a loan or a revolving line of credit. It's not uncommon to see this in B2B SaaS companies where there's high recurring revenue, consistent customers. A lot of companies that are doing this are looking purely for that kind of B2B SaaS or even B2B SaaS, so that there's that consistency among clients, users, and revenue that they can lend against. So CapChase is one of the companies that you'll see. I think Lighter Capital might do it. There's a couple different ones out there that will provide you these services. But again, cost of capital can be quite expensive there. A lot of earlier stage companies will still look at doing this. And it's an option if you're growing rapidly and need the capital, but it'll just be costly in terms of the actual interest and the payment that you will end up dishing out for these. SBA loans are a great way to look at financing your company early stage, especially with some working capital. We have a group that specializes in these ourselves. They're great. They're typically very competitive loans that are long-term at an early point in the development of your company. And if you can explore those, I would highly recommend them. They're backed by the SBA, so it helps a lot of banks deploy capital to companies that typically wouldn't be able to get credit, especially at the terms being provided. Lines of credit, revolving credit, those are things that you can look at typically later stage, depending where you're at. Sometimes you can put a personal guarantee early on. It depends how comfortable you are with a personal guarantee if you want to do that. And then venture debt is something that we'll discuss more here in the next slide. Venture debt is something that a lot of innovators will look at some point of their growth cycle. It's structured in a way to provide a much lower cost of capital. Now, I can say that it's still lower, than equity. Equity ultimately gives up ownership, but for the last 3-4 years, venture debt was very advantageous. Now, with interest rates coming up, we're seeing a bit of a slowdown on it, but still in terms of ownership and giving away the percentage of equity that you typically do in a venture round, it still can be quite advantageous. On average, especially early stage, you're giving away 20% of your company each round. This is a way to either reduce that or to increase the amount of capital you've raised per round and allow yourself to have additional runway so that the next time you go to raise, you're getting either a higher valuation, you need less in terms of capital, so you don't might not have to dilute yourself as much that next round. And it's really advantageous in the sense that you can get this instrument that's typically 3 or 4 years in length, and it will, even if they take warrants, typically be 1/10 of the dilution that you would take on the equity side of things. You can get into some certain caveats on these interest only periods as well too. Sometimes the first 12 months they'll look at doing interest only. Again, I mentioned warrants help improve your optics. And then there's a focus here really on kind of more your burn rate and your liquidity, less potentially on revenue. And they'll really look at who's providing your capital and the ability for you to continuously get capital in your next equity raise as one of the main indicators of whether you can receive venture debt or not. So it's a bit different than what you would get in a senior secured debt, where they're looking at your typical revenue, your cash flow, all that. It looks more at your ability to raise external capital than those markers, although those markers do help if you're earning a lot of revenue as well. It's never going to be a bad thing.
Hey, Derek, if we could just pause on just venture debt, maybe trying to tie together some of these concepts. I mean, as you know, you kind of started at the beginning with the slowdown in the deployment of venture capital, and then as venture debt is often used, they're looking at the company's ability to go raise more and more venture capital. So is this just is venture debt drying up at a faster pace than we're seeing just with traditional equity investing? Like how are these kind of concepts affecting each other?
Yeah, so let's go to the numbers. So look, if you look at US venture debt in 2021 and 2022, the numbers there are substantially higher. You have 32 and 34 billion being deployed. 2020, you have 30 million. So you can see that traditionally, even outside 2018, 2019, venture debt, has slowed down. The typical structure on a lot of early stage venture debt is in a company's an equity raise. Let's say you want to raise $10 million and you want an extra 2 million. You can then pull on venture debt. The debt grantor or the bank would get comfortable because you have 10 million of equity coming in on that equity raise, and we'll be able to pay down that 2 million over the 3 or 4 years, assuming you'll be able to raise another piece of equity financing in 18 to 24 months when you typically would. So you can see venture debt has slowed down. You also do have some extenuating circumstances this year with both First Republic and SVB, having issues and being the primary distributors of that debt capital. So it has slowed down, you're very right, and it's a very astute observation. But it'll be interesting to really see in Q3, now that there's been some stability in banking, if it doesn't ramp right up. From what I've heard internally from people I know, we're starting to see a lot of deployment of venture debt, but we'll need to see those marks till we can say anything. Does that make sense, Ken?
Yeah, I guess I'd also wonder like what is attracting venture debt now? Because it does seem like a lot of the high cash burn, high capital raising type companies have kind of fallen out of favor, and so maybe the question I would ask is like, is it primarily being like attracted to companies that are backed by the billion-dollar type funds because they know that there is going to be substantial follow-on capital in those companies?
Yeah, I think that's a good question, because a lot of what the due diligence is looking at the companies that have backed prior to issuing the venture debt, the company through their equity raises. So if you look at, the companies deploying the capital, you're typically looking for a fund manager that's deployed multiple funds. This isn't their first one, has an established track record, has, been successful in kind of fund 1, fund 2, fund 3. So to answer your question, if it's $1 billion fund and they're funding this and they want venture debt, is it easier to get to a yes? More than likely. You have some, good validation of the actual investment. But if it's a smaller, earlier stage fund that's not maybe on fund 2, fund 3, they've raised, $100 million. They have a good track record. Can you still get there? There's a high probability that you can. There's also a lot of CVCs that have been continuously deploying as well. And we see them and get comfort as well, because not only will they have a vested interest financially, strategically, they also see something there and can help us to validate a lot of the technology risk that's inherent with some of these companies, where you're getting into AI, when you're getting into a lot more complex technology that you might not have, a background in, especially on stuff like life science, healthcare, anywhere where, you really need someone with a doctorate to help you understand that. Having CVCs alongside is sometimes quite helpful as well, too. Answer your question, Ken?
Yeah.
Ken, on that same note, Derek and I talked about it a little bit, just high level, that, with the disruption really from, the prime drivers of this banking earlier this year, there was a concentration of knowledge at those banks as well. And I think you're seeing some of that now spread out to other institutions. But with that, there's a knowledge gap that has to be, the time for an institution to get their arms around some of that knowledge as they're learning new things. I think the hope is that as that spreads out, you'll see actually more institutions getting involved, and you'll see, those numbers recover over time. But certainly the blip of, March, April, May, in that space where it wasn't a factor of credit from the venture debt side that drove those banks to where they ended up. I think it's just a time of making up some of the knowledge of the industry throughout newer institutions.
Yeah, you're definitely going to see some newer institutions start to dabble in the space. A lot of SVB, former employees, First Republic, Signature, have gone to larger institutions as well as other institutions, and are kind of in that planning phase, post bank collapse over the next 3 to 6 months, where they're looking at launching similar products. So things are coming, and don't be surprised if those numbers again start to spark up now that you're seeing other institutions enter into the area. And you saw, in terms of the actual book, like Ben had mentioned, a solid debt book that continues to grow.
While we're here, before we get to really the banking basics piece, maybe a good time if there's any questions on that innovation piece that Derek just went through, because it's not necessarily a 180, but it's definitely a little change to a little less of the shiny object, what I'm going to be speaking to just on the basic side. So before we make that 180, are there any questions from what Derek just presented? Particularly to, Ken jumped in with venture debt, whether it be on the debt side or the equity side.
I have a question, Ben, and maybe you showed this, but I just didn't catch it. Do you have projections where you see 2024, Derek, going? So, this drop off in 2023 is obviously pretty large comparable, but are you showing kind of where next year is going and the year after?
Yeah, in terms of which numbers? Just in terms of general venture capital deployment?
Yeah. If there's so much dry powder right now, I'd assume that next year it would have to be deployed, or there at least be some cycle by 2024 or 25 when those funds need to deploy, that you'll see a spike.
Yeah, I think if you overlay the dry powder and spread it out kind of equally over the next 2 to 3 years, the stuff that was raised in 2022 now being deployed 23, 24, 25, and take, depending on the fund itself, each fund will deploy initial investments at different percentage. But if you do a rough approximation and you take out 21 and 22, you kind of see a pattern where there's a smoothing. It's almost linear, and it's going up depending on like how they fund that, whether they continue to slowly deploy now or whether they, wait to the end and deploy it all. There could be spikes. And depending on how smoothly they deploy it, multiple expansion could play a part of that as well too. When things get frothy, as we saw in 2021 and 2022, people are just deploying to get capital out the door, multiples go up, investors are able to take advantage of very healthy valuations we'll see, and we saw that throughout 2021 and 2022. Carter raised at 42 times sales at the point where they raised. And, a lot of these companies, they raised at multiples that they had to work into and are now looking at potential down rounds. So it's depending on how well venture capitalists handle the next 2 to 3 years, we could see an either smooth growth from the 2018, 2019, 2020. And if we cut out 21 and 22 as outliers, or we could see a bit of a up and down based on, how they deploy that capital. We saw in Q1 to Q2 of this year, about 500 million go out in Florida and then 800 million go out in Q2. If that kind of continues along that kind of cycle, we'll continue to see upward growth, and just depends how responsible and how quickly people are able to deploy capital over the next couple of years. And then post that, it's going to really be dependent on the fundraising that we see in 2023 and 2024. So while 2021 and 2022 provide us this dry powder that looks great over the next 2 to 3 years, we also have to be very aware of what's being fundraised in 2023 and 2024, because there could be a cliff that we end up walking off if capital isn't consistently allocated to this asset class. So it's a somewhat, it's a leading indicator here, how much has been raised as well as how much dry powder, but we have to watch it consistently. And it could mean that, 2026, 27, 28, are the really hard years.
Yeah, thank you. That's interesting. There's a handful of entrepreneurs that are probably on this call that are in the process of looking to raise capital or secure some type of funding. And not that I think there's ever an easier time to do that versus not, because it's always a heavy lift. But what's interesting is obviously there's not a lot of capital being deployed this year. Perhaps, waiting till next year, there's some better terms that might be available for some of these companies that they're a little bit further along in their journey, but also a little bit more access to capital that needs to be deployed come early next year.
Yeah, and that's the hope. And hopefully multiples stay at a responsible level so that we have that consistent outline of capital. And if it gets, again, where people are deploying a lot quickly, we could see a spike up and spike down again. So.
Thank you.
Thanks.
All right. Any other questions on just whether it be the capital side of things or the debt side of things before we get into just some of the basics around banking?
Any trends you can share on the deployment side? How closely do you track where it ends up, either size of company or vertical it's in? Obviously, some here in Florida are more important than others, but from crypto into Web3 into AI now. I know you shared briefly that you do see AI deployment, but any other macro trends on the receiving side that you might see?
Yeah, so we keep track of those as well too. Not at a state level. I don't have the data points necessarily to aggregate at a state level, but at a countrywide level, you're still seeing, software taking a majority of it. On that B2B SaaS side, a lot of allocators are very comfortable there still in terms of gross margin, revenue concentration in terms of recurring versus non-recurring. So we see it there. Obviously on the Web3 side of things, diving into, crypto and a lot of that, obviously we're starting to see a big slowdown there. And that could be, if you look at especially Florida, where you had kind of Web3 taking a big stronghold in Miami, as well as multiples that, were potentially out of line with where they should be long term. 2021 and 2022 definitely saw a constriction of Web3 in the allocation there. And now we're at kind of 1.3, 1.4 billion, which is more in line with prior to the spike in those sectors where we saw it. if we're looking and, just based on the marks that we see roughly, fintech still very, very strong throughout Florida. We're starting to see a lot of that fintech kind of spill over from Latin America, where Miami is definitely a landing pad there. Fintech is huge growth in Latin America, where they're really starting to put that infrastructure in. Subsequent to that, healthcare and life sciences is the other big sector that we're seeing deployment in Florida. And then you're starting to hear discussions on kind of blue tech, kind of that green tech, clean tech, whatever you want to call it. I'm starting to see money being deployed or circled around there. And then prop tech as well, too, is another area that you've seen in Florida where we hear about it quite frequently. If you go countrywide, there's a more diversification across sectors. And then obviously New York, very concentrated in fintech as well, too. And we see a lot of kind of crossover from New York to Miami, at least, as well as kind of throughout Florida.
Got you. That's helpful. Just any nod to manufacturing, this resurgence, reinvestment in U.S. manufacturing? Do you see any signs of that?
That would be a bit out of my area in terms of like technology that helps manufacturing and kind of, either enhanced CRMs, ERPs, anything to that extent. We're seeing still a lot of that, but just general manufacturing numbers, I don't have reference to that. I can figure it out. If you want to talk to me offline, we can take a look at it. But a lot of what we see is more technology designed to enhance manufacturing, less than manufacturing overall.
Gotcha. Thank you.
I can tell you in terms of where we're seeing kind of we are seeing outsourcing on a lot of the companies that utilize the technology who are manufacturing to low cost centers, both on kind of the development side as well as the build out side. So seeing a lot of things being built out, either still some in China, LATAM for a lot of the development in terms of software developers, as well as Israel, Tel Aviv, a lot of things being offshored there as well.
All right. We'll wrap this up with a few more minutes of Q&A, but we'll get into really the banking basics, right? Derek, definitely has the flashy part of the presentation as far as any dealing with debt and equity. It's just at the end of the day, it's a more fun conversation. But really the bricks and mortar that gets a business to that point is some of the banking basics, right? So what do you need to open a bank account or bank accounts to get your innovation company, underway? Making sure you've got your articles of incorporation, setting up the correct kind of corporate structure, whether it's an LLC with GPs and LPs, or if you're strictly going with the C Corp route, you need operating agreements, or in the invention of a C Corp, you need your bylaws, really outlining how the company will be run. And then, of course, your tax ID number provided by the federal government. Knowing who will be able to control the inflow and outflow of money, so account signers, whether it's just the founder or a loan, or if there's, from the standpoint of how those bylaws and operating agreements set up, if there's a manager in place, knowing, that having that information ready. If there's a CFO, a temp CFO, a controller in place, who needs access at least to the accounts to keep records and really to reconcile accounts on a regular basis. And then ultimately the beneficial owner, which is typically in a fractured ownership standpoint, your manager of the company, or if it is still early stages with the founder representing it, anything with a 25% or greater ownership percentage of your beneficial owner. And then how you set the account structure up, an operating account, which is your day-to-day account activity, inflows and outflows of money. And then particularly in today's environment, reserve accounts to earn interest. With where interest rates are today, certainly to Derek's side on the venture debt conversation, things have gotten a little bit more expensive, but with reserve accounts, there's an opportunity to earn some real interest on excess funds. Moving money, throughout, the world really, primarily right now, 4 primary ways. Checks were, the most antiquated way, a paper check to write. Also, probably the most dangerous way to send money. Every time you write a check, you're issuing your account number out to the world, and you also are at the beholden of the check receiver as to when that money will clear your account. Where ACH, ultimately you have a little bit more control over when that money is sent. It's sent electronically, a much safer way to transmit money to the other side, as well as to receive money. It's a lot quicker from just a collection standpoint as well. From a smaller dollar amount transfers, Zelle, Venmo, Cash App. I mean, those are definitely ways to send money in early stages, but also very risky from just a technology standpoint, as it's really run through a third party, and ultimately can be jumped between, and then wires, which is really the fastest and fastest, most efficient way to send large sums of money. However, can also be where the largest amount of fraud happens in a large dollar amount standpoint. And then there's really the future of where I know we would love to see banking go, and I think it's a bureaucratic steps to get there, which is 24/7 money movement, right? Where some of what you hear are the advantages of cryptocurrencies is the 24/7 access to those funds. Where now you've got FedNow, was recently launched and is kind of in its I'd say beta stage to be rolled out with a 24/7 application to banking, and then eventual hopefully adoption long term of blockchain and the technology that comes with that. You spoke briefly just in setting and how you're sending money, fraud protection, that is ever prevalent in our world, to the amount of fraud that's in there. On the banking side of it, it's having hundreds or thousands of households within a bank. You see it on a daily basis, where it's either check fraud or wire fraud and all sorts of different applications to it. And really, there's ways to protect it. There's Positive Pay, which has been around for the better part of 20 years, which helps monitor the checks that you write to make sure there's no fraudulent checks going through. There's an ACH Positive Pay, which is very similar to that, to make sure there's no debits or credits going through an account without either a proper list to verify on the front end, or even to follow up and verify in decision on the backside. Again, protecting, particularly if you go out and raise capital, you've got a significant amount of funds that investors have put into a company. So to keep those funds safe and not have a single dollar lost to the standpoint of fraud is important. And then I'd say the scariest version of fraud we see ultimately is wire fraud, where someone hops into an email and wire instructions get changed, and someone ends up sending a $2 million wire to an account that wasn't intended to. So really confirming wire instructions is really the safest step to take anytime you're dealing with sending something, even if it's a known commodity, to make sure you've got the right wiring instructions in place. Because once wiring funds are sent, it is very difficult to recoup those funds. Or usually, if it's fraudulent, it is they are dissipated from the account that was received into very quickly. And then I'd say one of the things that it was a really hot topic, particularly in 2023, is FDIC insurance. Going to March of this year, with the failure of SVB, the biggest overhang of uncertainty for a lot of depositors was, will my funds be insured, even though it's over the $250,000 limit? And ultimately, there are tools and mechanisms in place to protect that. the IntraFi network, which has actually been around for a number of years. It was very popular during the financial downturn of 2008, 9, and 10 to protect funds. Ultimately shares excess funds over $250,000 to other banks within the IntraFi network to hold that same $250,000 level to ensure upwards of $100 million. Really depends on the number of members within IntraFi to what that dollar amount is, but it is a significantly higher level to what your standard FDIC insurance is. There is a slight charge to the IntraFi network. It's 10 to 15 basis points, typically depending on the institution. But for the peace of mind, it's usually run through whatever the interest charge or interest income side is. So it's not a hard charge to the client. But I think the peace of mind on the insurance piece has driven that to a very popular item today. That kind of wraps up some of the banking basic pieces of the conversation. Again, certainly not as illustrious as the venture debt and venture capital side of the business, but ever important, particularly as you're setting up. We'll open it back up to Derek. Actually, any comments from you on either the banking side of this or further comments on the debt or equity side?
No, but I can talk on one of the things you brought up, and being at SVB, being part of that bank run, the IntraFi network is definitely something that has gained a lot of popularity post that, and allows you a lot of the protection that a lot of clients that I had to deal with firsthand really struggled with, especially when you have, put everything into these companies that are growing rapidly. So we see a lot people feel comfortable with that, and it's a definite tool that's advantageous.
Thanks, Eric. Yeah, it tends to rear its head whenever there's uncertainty out there. We'll open the floor back up to questions. It looks like Ken had to step away for a minute.
Any questions from the group? So there's only about 3 minutes left here, Ben, but do you have a contact screen so people can get in touch with you, or drop your information into the chat? There's a ton here for everyone that's really interested in this space to digest. Trends are definitely indicators for us moving forward as we look backwards. So I think the landscape has certainly changed this past year. But Orlando continues to grow in the tech sector, and need for capital and needs for line of credit, or even FF and F, which, by the way, I'll be using. I love that. There's obviously an opportunity out there where in order to grow our businesses, capital is essential. So this has been exceptionally informative, and I really want to thank you both for presenting today.
Really appreciate it, David. Appreciate the opportunity. We didn't have a slide with our contact info. Ultimately, wanted to try and be respectful of the OTC and not have this be necessarily a huge Cogent sales pitch. Although, obviously, we love and respect every member of the OTC. But we'll leave our information here on the chat, and we'll also maybe when we send out the recording of this, include that information just for follow-up questions or comments.
Yeah, that would be excellent. Excellent. All right. So any last thoughts, or anybody have any last questions before we hop off here? All right. Derek, Ben, can't tell you how much I appreciate this. I think opportunities for us to learn and really see where the markets are and where you see it from your side is incredibly valuable for us to build our businesses. So thank you so much for taking the time this morning with all of us.
Thank you very much.
Take care.
All right.
Thanks,
Cheers.
everyone.
Happy Tuesday.